We're back at 39 minutes after. Today, we wrap up our week-long focus on hedge funds with an overview. As hedge fund managers look to take advantage of volatility in the markets, what are the funds saying about equities and arbitrage? And how are hedging strategies affecting individual markets? Well, with us here in the studio is Charles Gradante. He's managing principal over at the Hennessee Group. Good morning.
Good morning, Carol.
So you guys track the hedge fund industry, performance month to month, correct?
Yes, and we invest money for our investors in hedge funds.
Well, let's talk about the performance so far.
Yeah.
How are things stacking up this year?
Well, year to date, hedge funds are up 39 basis points, a whopping 39 basis points. But considering that the Nasdaq is down 8%, the S&P is down 2%, there is some marginal, alpha being generated by hedge funds.
So not too shabby in comparison, relatively speaking.
Relatively speaking, but disappointing for hedge fund investing.
Charles, is there any correlation between what's happening in the overall market and then the performance we see in hedge funds? And of course, hedge funds use a lot of different strategies. But
yeah, I think one of the most overused words is that hedge funds are absolute return strategies. They're really relative return strategies. They're less relative than most strategies, and so the low volatility in the stock market, the flattening of the yield curve has affected strategies in both the equity side and the bond side. Yeah.
What specific trends have you seen in terms of hedge funds this year? What kind of?
Well, the best strategy is the short bias strategy. Those managers are up 13%. Everybody else is between down 1% and up 2%. But short bias has been up 13%.
We talk a lot about oil every morning. We talk about inflation, the dollar. What are things that you think hedge fund managers are specifically concerned with at this point? What are they tracking?
Well, right now, hedge funds, and we invest in about 120 hedge funds for our clients, so we have a good overview of what's happening there and our tracking. Hedge funds are long the equity market, short the bond market, and short the oil market, and equities haven't done much this year. Bonds.
That hasn't always that's not turning out so well.
Right, the bond market, the yield curve is flattening. The hedge funds are betting that the yield curve will steepen, and hedge funds were shorting the oil market, and oil hit an all-time high in March.
Are you surprised that they're shorting the oil market at this point? There's some debate about what happens next, and certainly the trend this week has been lower.
Look, you should be long gasoline prices, but short oil because the supply of oil is in excess of inventory needs. So when supplies hit all-time highs, hedge funds started to short oil now, but oil kept going up, and the fear factor in the oil market is driving it. So
based on what you're hearing in terms of kind of trends we're seeing in hedge funds so far, what does that tell you about the overall market condition here?
It's difficult. It's very difficult, and we're not seeing a directional trend. I think we need oil to go down to a range between $48 and $52 a barrel for hedge fund managers and the market in general to become more confident in adding more risk to their portfolio. Right now, there's just too much risk in what oil will do, interest rates, inflation, and all the other things we're talking about. And there's event risk. This AIG situation, Pfizer, General Motors, these are surprises. No one would have predicted this a year ago.
What does, I guess what I want to ask you, there's been a lot of concerns about the growth in hedge funds, a lot of attention paid certainly to hedge funds in terms of increased regulation. You're working with a lot of different hedge funds. Do you think all of this that's going on, the growth and also the increased kind of scrutiny, is a good thing?
I think it's very good for hedge funds in that they will have to become more institutional in how they manage their business. The SEC will perform periodic audits, which will pretty much force them to have procedures and policies and comply to standard money management regulations, like front-running. Their traders will not be able to front-run the hedge fund in investing in stocks.
Do you think there's been cause for concern, good cause for concern here?
No, but it's like a black box right now. So when you can't have the full transparency you want, you tend to assume the worst case. I mean, long-term capital didn't help. They're not the poster child for hedge funds, but it didn't help.
But it was one major incident.
Right. But there are a lot of misperceptions about hedge funds. For example, it's believed that hedge funds have moved oil by at least $5, maybe $10. NYMEX came out with a study in March. James Newsom, who's president, was quoted on the study as saying that hedge funds do not add volatility. In fact, they dampen volatility and they provide liquidity in the futures market. And they only really account for about 3% of the futures trading. So that's a misperception that those kinds of misperceptions are pervasive in the marketplace about hedge funds.
And do you think that that's just particular to commodity markets, or do you think that applies to everything?
I think if the New York Stock Exchange did a similar study in NASDAQ, they would find that hedge funds provide liquidity and dampen volatility, and that on the fringes, there might be some hedge funds that are cowboys,
right.
But in general, hedge funds are not the elephant in the swimming pool.
Okay, good point. We'll leave it, unfortunately, on that. I wish we had more time because there's certainly so much to talk about when it comes to the hedge fund universe. Going to leave it there. Have a good weekend. Charles Gradante there,
Thank you, Carol.
Managing Principal at the Hennessee Group.